99% of people do this the wrong way. Most people, they buy life insurance thinking that it'll grow cash value. But let me break it down exactly what that looks like. Money that goes into the policy, that's called your premium. You actually are able to pick how much you put into your policy, and you can customize the death benefit to make sure that it's a nice fit for that amount. Once that money is inputted into the policy, first thing that always comes out is going to be the fees. Now, 99% of people do this the wrong way. Let me show you what that is. They will only put in just slightly over the amount of fees that the policy costs, leaving them a small amount of money growing in this policy. You want to put in the maximum based on the IRS guidelines, depending on your age, your health, if you're male or female, and the death benefit amount. That being said, what we want to do is hit the max. Every year we want to take advantage of the full capability of this policy. And a lot of people will say next, why would I put that much money in just so then my family can get it when I pass away? No, that is not how we're going to do it here. We're going to make sure that you're able to utilize those funds while you're living. Let me show you. Borrow your equity, which is money that you have in the policy above the fees. So it'll be this amount. And the key part is, where is that money coming from? Is that money coming from your account, or are you borrowing money from the insurance company? If you guess number two, you're correct. This insurance company owes you money either to you while you're living or to your beneficiaries when you pass away. So they allow you to borrow against the asset that you've built with them. And if your policy was worth $500,000 at any given time, you can take a loan from the insurance company and they would simply reduce the amount of equity that you have at that time. Meaning, let's say if you wanted to take out $20,000 from this policy to go purchase another asset, what you could do is borrow from the insurance company. They would simply just reduce your death benefit by the amount that you borrowed. Let's say if you took a loan from your life insurance asset, the insurance company would say no problem because they already owe you $500,000 at the end of the day. And then from there, pretty simple. You're going to continue receiving money throughout your lifetime, keep building up this asset and borrowing against it as you need it. By doing so, you're going to solidify a permanent life insurance policy that will continue to grow throughout your lifetime, and hopefully use the money that you loan from your life insurance policy to go buy other assets like real estate, crypto, stocks. This is simply going to be the new instrument that you use to bank with. And if you want to see real numbers of what this looks like, click the link in the bio. Peace.